All right, welcome back to another video. My name is Ian Major. I'm an entrepreneur, Bitcoin pleb, and all-around raging capitalist. And in today's video, I'm mixing it up a bit. I'm doing an update on the kind of macroeconomic backdrop, focus around this question of is the inflation we're observing transitory or not? Macro has always had a soft spot in my heart. I studied finance back in the day. And macro was really what led me to enter the bowels of the Bitcoin rabbit hole originally. So for that, I am forever thankful. And I also continue to find it fascinating and really interesting. It's important to note that, Bitcoin's success is not dependent on the absolutely stupefying, levels of central bank money manipulation that we see in our world today. Right? It's certainly not dependent on that, but of course that does influence the trajectory and path that Bitcoin takes. So in this video, again, I'm going to break down kind of is the inflation we're seeing transitory or not. Many of you watching this are probably like, what are you, crazy? Like, my food packages are getting smaller per unit of fiat. Prices are going up for the same amount of stuff, et cetera, et cetera. But it's not, it's not that obvious to the broader population. And so in this video, I'm going to really lay out a lot of evidence to show kind of what's going on. And so you won't want to miss a thing. For those of you who are returning to the channel, welcome back, my friends. As always, it is great to have you. And for those new to the channel, welcome to you as well. I invite you to consider subscribing if you find this content useful and valuable. Not only will that benefit yourself, I cover all manner of things in the Bitcoin universe, and Bitcoin is such a multifaceted topic. While I cover a lot of things focused centrally on Bitcoin, whether it's wallets or the technology itself, etc., I also find it interesting to cover some of the other facets, Austrian economics, macroeconomics, such as what I'm doing in this video. So if that sounds interesting, I invite you to subscribe. That also helps get these messages and important tools and learnings out to a broader audience of folks on their quest to achieve financial sovereignty, which is what this channel is all about. With all that out of the way, let's go ahead and dive into this chunky question of is the inflation we're observing transitory or not? It's not transitory. You can now exit out of this video. No, I'm kidding. Keep in mind that we've seen really 30 plus years of disinflationary, maybe stretching even close to 40 at this point, of kind of disinflationary conditions. And even coming out of the great financial crisis of 0809, we perceive there to be all this kind of money printing and quantitative easing, right? Where essentially, banks are buying up government debt and then turning around and selling that to the central bank, right? Like all those forms of manipulation, we're used to sort of thinking of like all this money sloshing around. But in the case of QE alone, right, it really just pumps money into the financial economy. And we hadn't really seen, although I think many of us can probably agree that the CPI measures in the case of the US are incredibly manipulated at best. But suffice it to say that a lot of that activity and money printing remained in the financial economy and didn't really get to the real economy. So you have, no joke, many economists today and arguably even the market in aggregate itself, as we'll discuss, has this sort of consensus view of, the inflation is transitory, right? We have some temporary shortages resulting from COVID and supply chain shocks. And you mix that with quite a bit of, fiscal stimulation in terms of, some of the aid packages that have come out as a result of COVID. And sure, that was always going to create some, inflation. So let's pick apart what the sort of, what the sort of evidence points to. A lot of the, this debate has been going on for months and arguably even a year plus, of course, since, COVID kind of came in and governments began reacting. But let's, it's really reignited quite recently with this China credit impulse rollover. And so what you're looking at here is a a view of China credit impulse, representing kind of a yearly change. And what this basically is the growth of credit in China as a percentage of GDP. And so that is in the kind of dark green line. As you can see, it has taken quite a turn downwards, since sort of earlier this year. And so, a lot of folks are kind of pointing to that. And the reason they're pointing to that as this concern around deflation is that China's economy is, of course, one of the huge growth drivers at this point globally, given the size of their economy. So when you probably saw some of the headlines recently over the past couple of weeks and even a couple months talking about this growth scare, right? And what they're talking about is essentially this chart, that shows China credit impulse rolling over, potentially a harbinger of the evil deflation, right? But let's first establish a couple core facts, and this section is going to be quite U.S. centric, but that goes that makes sense because the U.S. dollar is, of course, the reserve currency currently. If you look at just deficit spending, right? I mean, it is utterly. I mean, it's hard to even take this in. Keep in mind this goes all the way back to nearly 1900, and so guess what? Guess where that line really starts to come negative? It's right about 1971. Guess what happened in 1971? That's right, the dollar was sort of delinked from gold, and really aside from the sort of blip right around 2000, it has been a one-way train down. Most prominently, of course, recently with the COVID crisis. That has in turn produced this view of debt as a percent of GDP. So, I mean, we are really rocking and rolling on this. It is way, way up there. I couldn't find a really, really good chart. They are out there that goes all the way back to World War II, which we will discuss. That was the last and really only point at which this metric was as high. And so that's just pretty astronomical to think about. But again, the folks out there will say, well, look at Japan. Japan's number is way higher than this. They're fine. They've been struggling with deflation. So why are you concerned about, the debt burden and all that? And indeed, debt does tend to suppress growth. But the next key view, and by the way, a lot of the kind of insights I'm showing here come from Luke Grauman. I am subscribed to his weekly newsletter, and it's one of the most valuable things I possibly receive. I am in no way compensated for making this recommendation. I just think Luke's insights are absolutely second to none, as well as Lynn Alden. So two of my kind of all-time favorite macro thinkers. But this view is something that Lynn has often pointed to. Right, we're going back to 2006 in this chart. You have QE alone, which mostly, as I was alluding to earlier, stays in the banking system or in the kind of financial system. Doesn't mean we haven't seen quote-unquote inflation. Just depends what it is that we're talking about being inflated. And in this case, it's really financial assets, whether it's stocks, bonds, even real assets like real estate. But when you layer on top of QE actual fiscal injections, so this is like government transfer payments in green, which are essentially the government kind of sending money directly to citizens and not relying on the commercial banking system to make loans, which is the traditional way that money is sort of printed, quote unquote. That's when you get significant growth in the actual kind of M2 money supply. And indeed, we can see that, right? This is straight from the St. Louis Fed. And we've seen, M2 money supply increase by 25% over the last year. That, just let that sit in, right? Let that sit for a second. The supply of U.S. dollars circulating increased 25%, over the last year. That is truly eye-watering and staggering. But I throw all of those statistics at you to just paint the picture of how dire the U.S. fiscal situation is. And we're going to use that to examine ways that it might get out of that situation, because it's not a sustainable one at best. So this next view starts to really hammer it home. What we're looking at on the left are the different sources of revenue that the U.S. government pulls in. I believe this is as of May 2021, so quite recent. And then you have on the right-hand side the different outlays, so what the government is on the hook for paying. And you can see things like income and Social Security, healthcare related, national defense, Medicare, the list goes on. But if you were to kind of do some of the quick math here, it is the case that if we take the interest that the U.S. has to pay on its debt, and we combine that with the required mandatory pay-as-you-go components of entitlements, so things that the government has to pay, these are obligations they have to pay, or it's essentially an implicit default. You add that up, and it is already well above the total U.S. tax receipts that the U.S. is pulling in. Said another way, the U.S. essentially already has to print money even just to cover its required, obligatory expenses. So that is sort of where we're at. Furthermore, if you think about the debt to GDP, that starts to get more and more concerning the more that grows. And so what the U.S. really needs is for GDP to stay nominally high. It needs to keep that number up so that the debt to GDP number doesn't get too out of control and set off a debt crisis. That would be a worst case scenario. And so if we look at this view, which takes the federal government transfer payments, so these are social benefits being kind of paid directly out to individuals that I was mentioning earlier, and it's in relation to personal consumption expenditures. So this is a broad measure of consumption, and when we think about the components of GDP, of course, consumption in the U.S. is the vast majority. We start to see an even more sobering picture. This is saying that, transfer payments are about 30 or so percent, give or take, of that PCE component, right? And that in turn is the biggest portion of GDP. And so the government really just doesn't have a choice at this point. If it takes the foot off the gas in terms of, continued sort of stimulus, it risks GDP going down. What happens when GDP goes down? Tax receipts go down as well. So that puts the government in a more untenable position if GDP were to go down. So that's tough, right? And you certainly can't have the Fed taking their foot off the pedal in terms of asset purchases of treasuries and trying to keep interest rates as low as possible. Because if if rates rise and interest expense goes up, as we saw, it's already in excess of total tax receipts when you consider not just the interest being paid on the debt, but also these other required entitlements and obligations that the government has. And indeed, we can see this, right? The Fed sort of recognizes this. We can look at this pretty zoomed in view of 2021 and just look at how the total assets on their balance sheet is increasing over time. And so we've tended to see more like 150 billion ish in asset purchases as opposed to their sort of guidance of about 120. So they're buying more than they've sort of guided the market towards. And again, that is reflective of weak demand otherwise. Foreign buyers in particular do not want U.S. treasuries. And so the Fed has to step in and sop things up. So, to recap that, right, you have this sort of untenable fiscal position whereby the U.S. really can't afford to have GDP go down. Because if it does, then it risks setting off a broader kind of debt crisis. And so and when you look at the extent to which stimulus payments have become a real significant part of consumption, then the government kind of has to keep doing that, and the Fed has to keep interest rates low because otherwise the interest expense would become untenable. So you have to sort of, if you're the government, you have to keep your foot on the pedal at this point, because if you don't, then you could do that, but guess what? Assets are going to crash, markets are going to crash. Pretty much everything other than the dollar are going to crash and set off a potentially horrible, deflationary spiral, debt crises, etc., which are just politically incredibly unpopular. Think of the Biden administration having kind of just come in. It's just not going to happen. It hasn't happened in any prior administration, and it's not going to happen now. And so, if we study history closely, not just the last century, but even longer, governments will tend to pick the more politically palatable option, even if it means the long-term consequences are going to be that much worse. And don't even take my word for this. There's this very interesting piece from a bipartisan think tank who lists Janet Yellen as one of their directors, right? About debunking some of the myths, the debt myths in the COVID economy as it relates to this idea that the central bank can keep buying government debt forever and ever and ever, and the government can keep sort of spending beyond its means forever and ever and ever. It's quite an interesting piece. I'll link it in the description down below so you can have a look. But it's sort of like the writing is in many ways kind of on the wall. You have notable policy makers who are clearly trying to sort of suppress this inflation narrative, an idea that maybe it's not transitory. But at the same time, you have pieces like this that sort of blatantly state why what we're seeing is simply not sustainable. And so where are we heading? In my view, we're heading to a world of financial repression. What does that mean? That means that the difference between what debt holders are making on that debt instrument versus what they're losing in terms of purchasing power via inflation, that is going to come down. We're already seeing this extraordinary picture. This is the very first time ever that junk bonds, so junk bonds are, high risk debt from kind of high risk entities. So there's more probability that these entities may default on the debt, right? So you would naturally, as a debt holder, demand a higher rate of return in order to hold that debt. This is plotting that yield minus the consumer price index. And even though the consumer price index is depressed in many ways through selective, choosing of which components form the index versus which do not, we are for the first time in history seeing that spread go negative. And so the sort of crescendo to all of this is an excellent view that is annotated by Luke over at Forest for the Trees. Again, check his stuff out. If you are not, you are missing out in a big way. But he basically makes this statement. So what are we looking at here? The blue line is GDP, year-on-year growth, and the red line is essentially long-term government debt. And what he's pointing out here is from the 1940s, i.e. post-World War II, when debt to GDP was at a similar level as it is now, the only way out that the government had at that point was to run the economy hot and inflate that debt away to a more manageable level. And so that's what's coming. Again, in my view, based on the evidence, is this financial repression where bondholders are going to get absolutely clobbered over the next probably decade plus, right? And you're already seeing this decoupling between inflation and bond yields. The market right now is clearly saying that it doesn't believe that inflation is going to be anything more than transitory. You've seen yields, stay very low. You would expect that if the market was expecting higher inflation, and by the way, those expectations have gone up, but you would expect a commensurate rise in yields, right? If inflation is going to be higher, as a bondholder, I want my return to be higher to compensate for that higher inflation. But that's not happening, and the reason is manyfold. Again, the Fed is buying bonds to keep rates low. There are government mandates that insurance companies and pension funds and things like that have to hold a certain amount of government debt in their portfolios, and so there's these different kind of government actions in place that are going to keep rates low even as inflation heats up. All right, I know that was a bunch packed into that section, but the key takeaways are that the U.S. fiscal position is simply in an untenable position. It cannot afford for GDP to go lower so as to avoid setting off a broader debt crisis. If markets were to come crashing down and correct, that would spell absolute society-level disaster in proportions that we really haven't seen, even going back to the Great Depression. And so, policymakers' backs are against the wall. They can either let the whole house of cards, built on this kind of towering system of debt, collapse in on itself, or they can keep kind of pumping the balloon. The latter of which is the by far more politically palatable option, is to keep sort of kicking the can. Let's talk about, though, a few other kind of arenas that are contributing to this story. So the other big piece, of course, is the push for infrastructure. It's not just the U.S. A number of countries are sort of jumping on the bandwagon for revitalizing their infrastructure. Of course, these are massive, capital expenditures. Biden here is, saying the U.S. ranks 13th in the world when it comes to infrastructure, and the American Jobs Plan that is being proposed is going to modernize roads and rebuild bridges and all this good stuff, right? And while that's perhaps a necessity, the fact remains that is not a recipe for inflation that is only transitory. That is very, very, kind of inflationary in nature. And indeed, we see the bipartisan infrastructure bill being forwarded. I think it's right now at 1.2 trillion. So again, just we're not even dealing in hundreds of billions anymore. We're dealing in trillions. And then the sort of final piece I wanted to just cover is the geopolitical landscape and how this contributes to inflation or not. We're seeing evidence here that the Biden administration is sort of extending some of the restrictions around trade with China. And this is significant for many reasons, right? One of the big disinflationary forces as it relates to U.S. consumer prices is the fact that the U.S. has been able to acquire relatively cheap goods from China for a very long time. And so as the exporter of dollars, the U.S. exports dollars around the world, and in turn is able to import goods that it needs for everyday life. And so there's this whole kind of backdrop of wanting to restructure supply chains that were found to be less resilient than thought about, which was revealed during the pandemic. And so if you're reshoring manufacturing to the U.S., you better believe that is inflationary, not disinflationary, if that is to occur. And just in general, you're seeing the U.S. dollar, sort of petrodollar system begin to fray in many different ways. You now have, by virtue of all the dollars that China is amassing, by virtue of selling relatively cheap consumer goods to the U.S., they're recycling those dollars back into assets like U.S. equities. And so you have Chinese entities taking ever larger stakes of U.S. corporate entities. And we know how influential corporations are to the sort of political process in general, right? That's not just a U.S. kind of comment. And you can see how foreign sort of ownership of U.S. corporate equities, there's also mutual fund shares and some other pieces, has really, really skyrocketed over the last couple decades. Furthermore, China is being very, very clever. They're basically able to, with all the dollars they amass, they're able to finance infrastructure deals as part of their kind of Belt and Road initiative. And so they could go to Kazakhstan, they could go to Somalia, whatever, some of these emerging markets, and say, hey, we'll bankroll and provide financing to build out this infrastructure, whatever it is. And so if the deal goes as planned and Somalia pays back the debt, China makes a spread, right? They've made money on that financing deal. If Somalia is unable to pay back the debt, China gets the collateral, right? And these are like hard resources. And so China is using the dollar system to acquire hard assets the world over and expand its reach, right? Like, it is what it is. And so for all the reasons we've now discussed, I personally believe inflation will not be transitory. There's really no other option for the U.S. but to continue money printing, as we've discussed. And given that this is now no longer just quantitative easing, but is sort of quantitative easing plus these direct fiscal injections, helicopter money, if you will, being sent from the government directly to citizens. We didn't even talk about some of the different kind of baby boomer dynamics and the 35 trillion that baby boomers have amassed that will be going in being passed on as inheritance to the next generation. I mean, there's a lot of factors at play here that make the notion of transitory inflation worthy of being skeptical. Let's just say that. And so in closing, I present you this award-winning meme in my book. There won't be inflation. There is no inflation. Inflation is transitory. And where we are now is inflation is good. You've even seen news articles come out that have the silver lining to inflation. Wages grow. Isn't that delightful? What they leave out is the fact that wages are not growing as fast as the price of your living. Don't worry, though. The ECB has said that negative interest rates continue to bring more benefits that outweigh their costs. We live in a true clown world. I don't know how else to summarize that. Let's go ahead and put this one to bed, though, and close this video out. All right, my friends, we covered a lot in this video. I know that was a lot. We threw a bunch of charts and graphs at you. And particularly for those who maybe aren't as well versed in the current monetary system and sort of how we got here to this kind of petrodollar, US dollar centric system that exists today, I'll link one of my videos in the description down below, which sort of offers a historical perspective of how we went from kind of a bimetallic standard to a gold standard to eventually what we have today. That's some very helpful context. But suffice it to say that through all of this, my thesis is that inflation will not be transitory due to the confluence of different factors we discussed as part of this video. And so what does that mean for Bitcoin? Well, of course, that is structurally bullish for Bitcoin. As I mentioned earlier, Bitcoin does not need such a backdrop in order to succeed, but it certainly would be a tailwind. And I think markets right now are sort of downplaying, the idea that inflation may not be as transitory as government officials would have you believe. But what do you think? I'm curious to hear your thoughts. Comment down below. I hope you enjoyed and found this video interesting and valuable. If you did, you already know what to do. Give this video a like. Let me know your thoughts in the comments down below. Themes and topics maybe that you'd like to see covered in future videos. But for now, after that action-packed session, we'll go ahead and close this out. As always, every sat counts, particularly in this backdrop. And until next time, I'll see you then.